Canadian mortgage delinquencies, meaning the people who have not paid their mortgage payment and are now behind in payments, are up 30% in 1 quarter. That's 3 months. It's up 30%. Is this telling us a certain story that I think the real estate bears have always wanted us to talk about? Well, I'm going to be breaking all of this down because this data is directly from CMHC. Now, after seeing this content, if you're a little bit concerned and you kind of just want to talk about your personal mortgage situation on your primary house or your investment properties, you can book a call with me using the link that's right here. What I found actually, like when a lot of people are calling me about this stuff, is it's interesting because some people are just not afraid at all and the risk tolerance and don't even realize the kind of problem they're in, whereas some people are perfectly fine and they're still freaking out. And it's like a really weird band of type of risk tolerance, and some people maybe just because they don't know, or some people they do know and they're a little bit overconfident, right? So if you're just unsure because of all the stuff that's happening right now, whether you think you're going to be feeling some kind of pain in the future because of the mortgage situation, you could book a call with me using the link that's right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run and operate a RE/MAX in the Greater Toronto Area, on top of making awesome educational real estate content just like this one for you. And if you found any of this content helpful in your real estate journey, make sure you give me a solid and smash the like button and subscribe to the Prime Properties channel. So the only thing we'll be reviewing on this reaction video is the CMHC Fall 2023 Residential Mortgages Report. And if anyone wants to read the entire report, it's kind of a snot fest, but I found a couple interesting tidbits, such as, people are 30% more delinquent than they were last quarter. I'll put a link in the description below to read the entire report. So one of the first things that I want to pull out on the chart from CMHC is this. Right here it says, borrowers have started to prefer fixed rate mortgages with terms between 3 and 5 years, with terms between 1 and 3 years losing popularity. So I'll rewind it for back where we were. So I would say in 2020, like mid 2020, when the rates start going up, and I would say the early part of 2023, getting the 3-year is very, very popular, right? Because it was not that much more expensive than the 5-year, because usually the longer the term, the more of a discount you have, right? And people always thought that, oh, hey, you know what? Maybe the interest are going to come down very soon. And that's kind of why I went with the 3-year, because you know what? I won't lock in my downside, right? Which meaning that, for 3 years, my payments are going to change. So we're good for that. And if it gets better in 3 years, then I have a lower rate, right? So that's kind of and that's kind of what a lot of people ask me too. I'm like, you know what? Just take the fix because you prevent the downside, because we don't know what inflation is going to do and whether they have to keep hiking rates. Or in the case of the fix, we don't know what's going to happen in the bond market, right? And what they think is going to happen in the economic turmoil that we're supposedly having with recessions coming in the future. So that's why 3 made sense. And now you can see over here on this darker line, the share of 3 to 5 years is increasing. What that basically tells me is that people are more pessimistic about rates coming down, or the idea of higher for longer is here to stay. Meaning that they're like, you know what? Maybe I don't want to take that kind of risk, and I'll just keep it at this amount for the next 5 years instead of 3. Now, granted, the 5-year is a little bit cheaper. I don't think by that much. Again, this report came a little bit earlier than right now, and bond rates for the fixed market have come down a little bit. But I think that a lot of people are just expecting higher for longer, and that's kind of why they're taking the 3 to 5 year instead of the 1 to 3 year, which, again, everyone has different risk tolerance, right? So everyone has a different idea of what they want to do with their mortgage. So I just found that very interesting. I've reiterated this many times in the past before. So you can see basically your risk tolerance is totally up to you, but you can see exactly what I was showing you earlier in 2022 when the rates kind of shot up, people are taking that kind of fixed 3 to 5 year more, right? So again, everyone's risk tolerance is different. What you plan to do with your mortgage is totally up to you. But if you're kind of concerned about where your situation is, you can book a call with me using the link that's right here. Now, another interesting chart that I have here, and I'll summarize kind of my thoughts on all of this after showing you all this data later, is that alternative lenders increased their market share in the first quarter of 2023. So alternative lenders basically being not your big banks, your colorful rainbow banks, right? Big 5 or big 6, depends on when you include that last one. And you can see in this chart over here, it says market share of newly extended mortgages. So these are new mortgages, right? And the black line is basically 2021 when the rates were low. The red line is 2022 when the rates are hiking. 2023 is currently right now when, we call it maybe peaked, right? So you can see how the big six has started losing market share, meaning the amount of mortgages they could basically, or they have been creating is going less and less. So they used to be like, over 60, now they're at 50%. Where things are increasing, you see the non-bank OSCE regulated ones. So these could be like your monoline lenders, right? Or you got your credit unions over here. You can see that they're making some big progress as well, or like other non-bank mortgage lenders, right? And the idea of why I've highlighted this to you is the banks are regulated by OSCE, which is kind of the same thing, these non-banks as well, because you have the stress test. But when you go to credit unions, you're not regulated by the stress test, so you get a little bit more. The other thing I find is that there's this concept where if you were to get a B lender or even a private, you want to get into the prime lenders, right? So you want to go from like a private to like a B lender to an A lender, right? So the idea when people are buying properties, when maybe it was really hectic and crazy, right? Call it like in 2022, like early Q1 or 2021, late Q4. A lot of people may have been buying with B lenders or private lenders. And as interest rates gone up, when they renewed, we talked about this before as well, they went from like a fixed 1 year of B lender at like 3.99 to like 8%, right? People thought that was going to blow up the market. It didn't, but those are the people who have to continue staying in the B lender, or they have to maybe go in private because they can't qualify at these higher rates anymore, right? So the fact that we have a lot of people falling out of the big six goes to that kind of headline they have where the banks are deselecting them, right? Meaning they're not credit worthy enough, their income's not high enough, so they have to fall somewhere else. Otherwise they can't get a mortgage, or they have to fire sell their property. So seeing this data and seeing that the market share is increasing for the alternative lenders tells me that it's not that people want to go to them, it's they have to go to them. You see that? So this is another point that stress is coming, right? And you can kind of see in the previous chart right here, people are afraid of that stress, so that's why they're taking on the longer term. See what I'm trying to get at right now? And then this is kind of like the biggest chart of all, which is mortgage delinquency rate by mortgage values at origination, right? So where that 30% increase from last quarter to this quarter in mortgage delinquency is right here, which is that pink line right here. So which is basically a mortgage that is over 850,000 or so. So if we work back the numbers, 850,000 is essentially any mortgage in Ontario if you went to 80 loan to value. And what that means in layman English is, like, say the average price is, call it like $1 million something, and I'll just use $1 million for easy math. You have to essentially do 20% down, which means that you have a mortgage of 800 grand, right? So the average price right now is like $1 million one something. So your average mortgage, if you went to 80%, is basically around 850 or so. So this 850 or so mortgage, I would say like a lot of, Ontario and South Ontario kind of mortgage borrowers fall into this category. So you can see they basically went from 0.1 up to 0.13. So that's a 30% increase in the mortgage delinquency rate in just 1 quarter. Now, do keep in mind, I think delinquency rates are not the greatest kind of source of data because CMHC reports this every 3 months, right? So every quarter. And the banks don't have to report you as delinquent until, I believe, 90 days after you stop making payment. So that's 90 days, which is essentially 3 months, plus another 3 months in CMHC's reporting, which means that this data could effectively be like 6 months old, okay? But I'm gonna talk about like credit card loans a little bit later because that's probably more of a sign of like future delinquencies to come. But you can kind of see here that like mortgage delinquencies are coming up. Can remedies happen before they get to the delinquency stage? Like maybe the seller decides to sell before the bank's power of sale. I have more of that on this Thursday's video. I just compiled some data. Or like maybe they have effectively power sale and it's off the books already, right? So there's a lot of remedies before it gets into this data. So again, just because it's up 30% doesn't mean that it could be up more. Also could be maybe less, right? So this data a little bit slower, but it does give us some signal that, again, there's more pressure and stress coming down the way. Now, if we look back to historically, like 0.13 basically puts us back into like 2021 Q3, territory, which is not that bad. Like if we're going to go into like the pandemic territory, we're basically at like 0.25, right? So like I think Ontario historically is like at 0.16 or like 0.17. So like they're a little bit higher than normal for these like larger mortgages, but it's not that bad. Which I personally found very interesting in this chart because they do post a lot is like anyone with less than 200,000 mortgage seems to be more likely to be delinquent with such a small amount. I wonder if it's just because that's what they kind of started with because it's that origination and they've refinanced and they can't afford it anymore. Because that's kind of interesting, like people who use their homes as an ATM machine, right? Because I find it so strange that the smallest mortgage has like the highest delinquency rate. It's just strange, just pay it off, right? If it's sub 200,000. So this last chart here is basically the other type of credit products out there, right? So we're talking about, you got your HELOCs, which is kind of tied to the mortgages. You got your credit cards, your auto loans, and your line of credit, which isn't attached to a home, but it's maybe unsecured against something, right? So you can see we start from 2019. Your mortgages, which is the black line, is the amount of delinquency. It's very, very low, right? Very low, and it's still very, very low to this day, which kind of jives with this kind of data. This chunk here is still very low relative to this chunk here. Where we're starting to see stress right now is look at what bars are increasing. So the first thing I see right now is auto loans, right? So you can see that we're, breaking 2%, which means that people are missing their car payments. And if we go into a hierarchy of things, right, like, everyone is going to make their mortgage payment because they want to keep the roof over the head. You're going to shed the car first, shed your spending, which is why like GDP should be coming down because there's a lot less disposable income, but you're not going to not make your mortgage payment. That's why this number always comes up last. But when we see kind of delinquencies increase on the things that aren't as essential as like paying off your mortgage, that's when we know that the family household is having some stress, right? So you can see auto loans increasing. Again, probably because the cars are very expensive right now. And if you're going into like a stressful time, you probably just miss the car payment and they'll come after you and repo your car, right? As opposed to repo your house. Then you got your next one, which is credit cards, which is these gray lines going up. When you don't have enough income with inflation and whatnot, a lot of the credit cards will get missed, and these payments actually increase because a lot of people will use the credit cards for their cash advance, right? Because you're allowed to cash advance. It's a higher percentage, but they can get some kind of emergency cash before they have to go to like your payday loans, right? And then you got your pink line here, which is your line of credits, which is usually unsecured. So people are slowly starting to tap into that as well. It's like a lower interest rate than the credit card. Not everyone has access to it, but if you do, you will probably have the credit card first because those are higher interest rates, right? And then you got your little red one, which is kind of your HELOC, which is kind of tied to your mortgage. Again, they're kind of like stuck together with the mortgage, so we're not seeing a huge amount increase on that. But effectively, you can see here that a lot of people are defaulting on some of the first few things that they don't find necessary before they're home, right? So this tells me that there's a lot of stress in the system. And this is all, again, caused by higher interest rates. So the level of stress that each person has obviously depends on their financial kind of like, cash flow and also their like balance and kind of like a checking account or something so that they could survive until maybe the interest rates come down. But when I circle back to the idea that a lot of people are getting these kind of like longer term fixed rate, it tells me that maybe the people who are hopeful initially for like the rate to come down sooner maybe have just capitulated, or there's a lot of people like, you know what, I don't want to take this risk anymore. I'm just going to go for the longer long term. And we're going to see a lot of this happen in the next year in 2024 and 2025 when like a big bulk of the mortgages do come renew. A lot of people still going to go for 3 to 5 year? We'll find out, right? Because if there's a rate cut, maybe people are a little bit more aggressive and more bullish on where the rates are going to be in the near future. But at the current moment right now, yeah, there's definitely stress financially for a lot of people. And that's kind of why a lot of people may be trying to list their homes right now or see what it's worth, see if they can restructure the debt. Everyone's just basically doing what they can to hold on. And this is kind of why I kind of like put a lot out there. I've been taking a lot of like regular calls, maybe not even buying or selling, just trying to see what I can personally do to help other people who don't understand what's going on right now and if they have any options, right? Everyone's situation is different, and like what they're concerned about with the mortgage is always different because like if you have a condo versus a house, depending on which area, right? You may be easily more able to liquidate it, or if maybe you paid it down a little bit more, you can always re-amortize, but it's also based on your income and where your credit is, whether you started a good career, right? If your income is stable, right? So there's a lot of moving factors, and that's kind of why I think a lot of people are confused about what their options are, and when they see a lot of like negative headlines about what's going on, it is freaking some people out, right? So if you are in that camp and you kind of just want to get an idea of what all of this means for you and your personal situation, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Hopefully this helps because I know there's been a lot of negative news out there, and yes, delinquencies are up, but I don't think it's, at least from what I can tell, not large enough to affect the entire market. But is there potentially more pain to come when rates are staying higher in this kind of manner? I would say yes, and how we prepare ourselves for that is basically up to us, right? And that's kind of why I'm putting myself out there. If you guys need some help for this kind of preparation or whatnot, and if it does mean that you can keep the house, I'm more than happy to help. So you can use the link right here to book a call. So until next time, your move, your future. See ya! Now that I'm done watching this video, I think you should check out this video. And you know what? Why don't you check out this video too?